Hey guys, Pat Wood here again from DelphX Capital Markets, and I'm here with John Dieter, also from the company. As you folks, the people who have tuned into our last episode that we did about a week and a half ago, we promised you that we'd keep you updated on things and how we're doing within the company. So some exciting things to report, and we thought that they were relevant and certainly important enough to share with everybody. I guess so. So the last time we spoke, we were pretty candid about where the product was headed, who we were talking with, etc. We've had some very promising and encouraging discussions as we've brought both buy side of the protection and seller of the protection together, such that one group in particular, a very large insurance company, they came to us and they said, guys, I love this product. I want to use it. However, I need to see a couple of small changes to really affect me in a positive way should my bonds get downgraded. And with that in mind, as folks, as we tried to explain in the last call, and I hope we did a good job, the original product was a spread-based product. So if the bond changed in value on a downgrade, then whatever that spread change was, then that would be the protection that the insurance company investor would have paid for. However, that was a variable model. One of the things that didn't cover was the guaranteed increased charges that the insurance company would have to pay, because they do have to pay, once again, that graduated scale of capital charges that we went through last time, when their bond gets downgraded. And so they said, look, can we do a fixed payment amount such that if my bond gets downgraded, whatever that 100% known charges will be covered by the sell side, the person providing the protection. And so we adapted the product slightly to that end, to fit the need that specific insurance company asked us to provide for them. And our hedge fund partners have gladly gotten behind that. And now we're at the point where we are just modifying some of our documentation with our counsel to reflect this new payout structure, which is, once again, it's a very minor change, but it's one that really, like I said, fits that need. So we now understand fully that this one insurance company in particular, and of course John, and who's our head of capital markets and who's really our sales driver with with others. We now know that in speaking with other insurance companies, this is the final little tweak that we've had to incorporate, such that we know now that there's going to be action on the product. There are going to be transactions. 100%. We know that those transactions are coming together now because we actually have both sides, the insurance companies and the hedge funds, in the same room together. Once again, hashing out terms, negotiating where pricing will be, which names, which bonds, etc. So it's been a long and arduous journey to get here, but at this stage, we're very encouraged, and we thought we'd share this with you. But to that end, for many folks who are investors in the company or who are kind of kicking the tires on DelphX, they want to understand a bit more on the actual product itself. What is the solution? How does it work? Where's the need, etc. And so, because we've added this small, little tweak to the product, we thought we'd get out there and share it with you folks and keep the discourse going. So, with that in mind, why don't I pass the screen over to John, and he can essentially walk you through what this new change is, how it's relevant, and then we can just kind of cap off with a little summary once John is done explaining the new version. So, John, very exciting times for us. I know we're totally stoked. So hopefully we can share this with our base that's looking at this product, and walk them through. So I'll pass it off to you.
Awesome. Well, thanks, Pat. Appreciate the introduction. Nice to see everyone again on our weekly update calls. So what I'm going to do today is, as Pat mentioned, we're at the point where we have our hedge funds and insurance carriers in the same room negotiating terms. And, something that came up in the last couple of weeks since our last video is this chart that I'm going to share here, and the fixed payout model that we've now tweaked the product to reflect. So it looks like everybody can see that on my screen. So essentially, this is the NAIC risk-based capital requirements that these insurance carriers need to follow. So on the left-hand side, the far left column, you'll see the various different rating buckets. The RBC then column, the third one is the basically percentage of capital that they need to have to protect that position. So as we move further down the scale, you'll see a block of purple rated securities. That's really the sweet spot that we're operating within. So, what this new fixed payout model is going to protect against is for any bonds starting in that triple B category, all the way down to double B minus, we're going to protect any downgrades on a fixed payout basis. So on the far right-hand side, you'll see some initial pricing that we've come up with our hedge funds, basically an initial premium of 1.1% with a max payout of 4.5%, protecting any downgrades that happen within that triple B all the way down to double B minus. Directly from the mouth of the insurance carrier, they said this was really a model that would better fit their internal risk management strategies. And this is also some feedback we've heard from other insurance carriers was the main thing they're looking to protect against is that increase in capital charges. So before, with our spread-based product, sometimes a bond, the spread will already have widened, it's already been priced in. So the spread-based product maybe wasn't protecting enough of that capital charge, where this is really going to protect directly those increases that they're going to incur as those capital charges begin to go up as those bonds get downgraded. So as we have been continuing in our marketing efforts to various insurance carriers, this has really been resonating a lot more with them. They're saying, wow, this is really a product that we can take back to our risk management personnel and say this is something that really protects our positions, especially for the buy and hold shops who have a longer term view on these bonds, who like the names, who want to stay in these positions. This solution now really addresses a pain point in that interim to short term, which is the increase in RBC. So we really look forward to, these first batch of transactions coming together. As Pat mentioned, we have insurance carriers and hedge funds in the same room hashing out terms. We have other insurance companies that have lined up who are eager to get, a part of this first batch of transactions, and will definitely be a part of the next batch. So in the next couple of weeks, we'll look forward to sharing details on the first batch of transactions, including, issuers who are being protected, what some of those initial terms are. So stay tuned in the next couple of weeks as, the commercialization of this product really takes off. We expect to have some exciting updates for everyone.
Cool. Thanks, John. I really appreciate that. And I think, we will have a little bit more of this detail up on our website pretty soon. Really, kind of a little bit more of a deeper walkthrough. But as always, if folks have questions on this, they can always reach out to us. They know where to get us. Our emails are on the website. So if folks have questions about this, they want to dig in deeper, we're always there to answer those questions. And on our next podcast, we'll certainly walk folks through. So just so folks know, the company is in actually fantastic positions right now in the sense that, our products are looking great. The demand is there and transactions coming together, and revenues really, will happen very, very, very much in short order now, which is great because in the past, we've had promises of commercialization. We certainly were led to believe in a lot of cases that these transactions were coming together on the earlier version of the product, but Wall Street's it's a very finicky thing, and certain groups make promises, they walk away, and once again, that seems to be it's certainly been an endurance race more than anything else. But we know now that we have real partners, real groups, real users in hand, and that's what makes this very exciting for us now. So that being said, the company, like I said, is in great shape. We have a lot of cash on hand, so there's no need to raise capital anytime soon. As folks know, our company burn is very, very low, and we intend to keep it that way. Our major expense has always been legal, but to design a product like this, you need to work with the best. And so, our counsel is the best out there. And as such, the costs, the costs are a burden, a necessary burden that we've got to carry. So, look, folks, we will come back to you in the next week or two. with more promising updates, we're sure. Possibly some press releases in between now and then. But to that end, we hope this is helpful. Keep following us, and any questions, like I said, please direct them toward us. Thanks, John. I really appreciate it. Have a great day up in New York, and
Thanks,
we'll talk to you. Thanks, folks.